Well, could this earnings season lift the market to new highs? That is, of course, the hope. But one technical strategist says while we could see that, we could also see the market stalling after this quarter. So joining us to discuss his call, we have Stephen Suttmeier, Bank of America Chief Equity Technical Strategist. And Stephen, thank you so much for being here with us. I want to dig into your call here because there's obviously, like I said, a lot of growing sentiment that this earnings cycle is going to lift us to the upside despite whatever the Fed might be doing. But you think we might see a stalling after that?
I mean, I think the stalling is actually happening here and now. We've been highlighting 5200s as a potential pause point in the market, especially after that solid first quarter that we had in 2024. Few reasons why we come to this conclusion, and we just view it as a temporary setback. We do actually think the market does go on to higher highs after that. But right here, right now, April and May in presidential election years, which we are in right now, as everybody knows, the S&P can struggle. So I think we can struggle a little bit April, May, around this 5,200 level. Maybe you need to see 5,000. There's also some big supports, 48, 4,600. Not sure if you need to go that low. But after that, when you look at cycle work based on the presidential cycle, if we do back off a little bit, there is a case to be made that you get a nice summer rally. Normally, seasonality does call for a summer rally. It's not sell in May and go away. It's actually buy May, sell July, August. And in the fourth year of the presidential cycle or presidential election years, you can have a strong rally. So if you dip a little bit here, 5,000, 4,800, and then get the summer rally, we think we could be pushing towards 5,600 by then. So, that's the way we think the roadmap works with the presidential cycle and our positive technical trends on the S&P.
Stephen, what are you seeing just in terms of sentiment right now and the positioning between institutional and individual investors? Are you seeing any sign of euphoric levels, or is it simply just a bullish view at this point?
Great question. I think at this point, a bullish view. Individual investor sentiment has been elevated for pretty much all year, but it's not at euphoric levels based on the AAII bullish sentiment survey of individual investors. And we also look at institutional positioning of institutional asset managers in S&P E-mini futures. It's very similar reading there too. It's elevated and it has been elevated pretty much all year. So investors are now believers in the cyclical bull market that's been in place since we bottomed out in October 2022. And this is pretty much like the second phase of the market where, you would call it the participation phase where more people are involved, but not quite yet at those euphoric levels. So I would argue people are more bullish than they were a year ago, but they're not at peak bullishness, meaning contrary and bearish sentiment levels. We got a little bit more room to go there.
And talk to me about what you're seeing in money market funds as well, Stephen, and what that tells you about what we might be looking at moving forward. Yeah.
Sure. That's one reason why a pullback could be limited. Investors have a love affair with cash. And granted, cash is actually an asset class you can invest in and get a return in now, roughly around 5%. Where in the past, over the last decade or so, you really couldn't get any return there, thanks to Federal Reserve rate hikes. So cash level can be sticky to some extent due to that, but the equity market continues to have double-digit returns, which we actually think it can. Eventually some of that money is going to come out of the cash level. So if you look at all money market mutual fund net assets, it's over $6 trillion. So some of that money likely gets put to work in this participation phase of the rally, because the S&P just broke out from its 2-year trading range in December and broke out to new all-time highs in January. So, there's cash that could be put to work to fuel this rally, towards 5,600, maybe even higher than that.
Stephen, speaking of fueling this rally, what are you seeing in the growth versus value debate? Are you still seeing growth remaining in that bullish trend? And if you are, what does that then signal just in terms of the leadership that we will likely see ultimately for that next leg higher?
Well, I think the good news is this. Even though when you look at growth over value charts, a couple things to point out. First and foremost, there are bullish breakouts for both the growth side and the value side of the market, meaning that both these indices, if you look at Russell 1000 growth, Russell 1000 value, have broken out with new all-time highs. What's different, though, is that one of these styles is leading the market in a longer term bullish trend, aka that's growth, obviously driven by secular stories like AI. And the value side is still actually in a longer term lagging trend. So if I had to say a bigger picture, what's going to work over time, it's most likely on a relative basis, growth stocks over value stocks. It doesn't mean that you shouldn't own anything in value. I mean, because the market has indeed broadened out this year. Technology leadership, semiconductor leadership has been joined by energy leadership, selected financials leadership, selected industrials leadership. And given breakouts for many commodities out there, materials are starting to catch on too. So a little bit broader. So I wouldn't say it is an all or none deal for growth versus value. It's, you own some value, you own some growth, but I think bigger picture, at this point, the trend still favors growth over value overall. I just wouldn't put all my eggs in the growth basket. I would diversify, perhaps have some value names as well tied to the commodities, which are breaking out here.
Well, and for investors that are looking at that breakout, I'm curious from your perspective, how important is it to look across different asset classes, at commodities, bonds, stocks, and what does that help you suss out about the market?
Well, I mean, first and foremost, interest rates have gone from basically 0 to 5. Everybody thought that would have been bearish for equities. I think what has happened here is interest rates have been normalized. They're at average historical levels going back to the 1920s. And I think the market likes that. That is actually healthy. I think in this environment where you are getting commodities breaking out and, there's been more of a whiff of inflation in the air. I mean, you do have gold breaking out of an 11-year cup and handle formation that, some of our on the technical side, it projects about 2,800, but our fundamental strategists think you can see 3,000 gold. So, I mean, I think you got to have a diversified approach here. And I think that's what the message of the market is. I mean, the secular growth stories are secular. They should be able to work regardless of what the business cycle is. Sure, they'll ebb and flow, but over time, they will go higher. The more cyclical stuff, show the commodity stuff, breakouts are showing the market heating up a bit. So it argues that if you're trading maybe over the next few quarters or a year or so, maybe even a little bit longer, perhaps own some high beta versus low volatility. High beta does include some cyclical tech. It includes some industrial, some financials, materials, and energy. So, and if you take that ratio, high beta versus low volatility, it looks like it favors high beta. So I think we're in an environment where growth is favored over value, and high beta actually is favored over low volatility. So you're getting, more breadth in the market based on that.
All right, Stephen, we have to leave it there. Thank you so much for joining us and for sharing this research with us. We really appreciate it. That was Stephen Suttmeier, Bank of America's Chief Equity Technical Strategist.